Whenever a hot new IPO hits the market, a lot of retail investors immediately jump straight to the price band, or they get completely distracted by all the hype around the gray market premium. But the pros, the equity analysts and investment bankers, they actually start somewhere completely different. They go straight to the capital structure. I mean, think about it. Before you can figure out what a slice of the pie is actually worth, you need to know exactly how big the entire pie is, right? You need to know who's holding the biggest pieces, and crucially, how this IPO is going to change the size of that pie. Capital structure tells us who's really pulling the strings today, how the ownership has evolved over the years, and exactly what happens to the cash they raise. So if you really want to decode a company's financial DNA, well, this is exactly where you start.
Welcome to The Explainer. I'm really thrilled to guide you through this today. We're going to decode the complex and, let's be honest, sometimes pretty intimidating world of corporate share capital. And to do this, we're diving into a real-world case study. We're breaking down the official draft red herring prospectus, the DRHP, of Indo-MIM Limited. We are completely skipping the rumors and the outside noise. We're just looking at the raw, unfiltered data straight from their regulatory filing with SEBI.
So here's our roadmap for today. First up, we'll define what capital structure actually is. Second, we'll look at Indo-MIM's ownership history. Third, the current ownership hierarchy. Fourth, how the IPO is going to change that ownership. And finally, we'll wrap up with ESOPs and key investor takeaways.
To make all of this tangible, we're anchoring our entire analysis on our subject, Indo-MIM. Now, a DRHP is usually literally hundreds of pages of incredibly dense financial and legal jargon. So our goal today is to translate all of that jargon into plain, accessible English. Indo-MIM's filing actually gives us a perfect textbook example of exactly how a company's equity is structured, how it's managed, and how it eventually gets offered to the public.
All right, let's jump right into Chapter 1. What is capital structure?
Whenever we talk about capital structure, we're essentially just talking about how a firm finances its operations and its growth. Usually that's a mix of debt, which is borrowed money you have to pay back, and equity, which is actual literal ownership in the company. Today, we're focusing squarely on the equity side of that equation. Why? Well, because equity dictates who holds the voting power, who gets the dividends, and ultimately who absorbs the most risk. You're going to see two key terms in every DRHP describing this. First is authorized share capital. Think of this as the maximum legal limit of a company's equity. If the company was a bakery, the authorized capital is the absolute maximum number of pies their kitchen is legally allowed to bake. Then you have issued share capital. This is the portion of that authorized amount that the company has actually decided to bake and offer up to shareholders. You can never issue more than you're authorized to, but you can absolutely issue less.
Building on that idea, we arrive at what is arguably the most critical term for current valuation, and that's paid-up share capital. This is the actual hard cash the company has received from its shareholders in exchange for those issued shares. It represents the true, current foundation of the company's equity. So, when analysts talk about the size of the company's equity pie right before an IPO, they're talking about the paid-up capital. This is the money that is actually physically flowed into the company's bank accounts from the owners.
Moving on to Chapter 2, Indo-MIM's ownership history.
A company doesn't just wake up one day and arrive at an IPO overnight. Its corporate history is literally written in its share allotments. Looking at Indo-MIM, they were originally incorporated way back in April 1996, and actually under a completely different name, AFA Technologies India Private Limited over in Hyderabad. Now, over the decades, they went through a few name changes to line up with different collaborations and international branches. But financially speaking, a massive milestone happened recently. In June 2023, the company executed a subdivision of its shares, which is commonly just called a stock split. Basically, they took shares that had a face value of 5 rupees and split them into shares with a face value of 1 rupee. The overall value of the company doesn't change, but the number of slices in our pie multiplies by 5, which just makes the individual shares a lot more accessible. And then, shortly after that, in September 2023, they officially converted from a private company into a public limited company, which essentially paved the regulatory runway for this very IPO. Now, you might be wondering, why on earth do analysts care about something that happened in 1996 or even earlier this year? Well, it's because capital history reveals corporate maturity. By tracing these historical changes, professionals can really understand past equity adjustments. They can track exactly how the founders managed to maintain control over the years, and they can see how the company structured itself for long-term growth well before they ever asked the public for a single dime.
That brings us to Chapter 3, Current Ownership Hierarchy.
So we know the history, but who is actually sitting at the head of the table right now? Looking at the pre-offer capitalization is absolutely vital here. What we're looking at is the pre-offer paid-up equity share capital on a fully diluted basis. Just look at that. Massive dominance by the promoters. They're holding an overwhelming 92.21% of the company. And when you add in the promoter group, who holds another 1.13%, you suddenly realize that over 93% of the voting power and equity is tightly concentrated in the hands of the founders and their corporate entities. The remaining little slices belong to selling shareholders at 1.25%, with others making up the rest. Make no mistake, this is a highly centralized ownership structure.
Let's drill down even further into that specific promoter category. It's not just a diverse group of founders sitting in a room together, it's actually highly concentrated into one single corporate entity. Green Meadows Investments Ltd. holds a staggering 90.84% of Indo-MIM all by itself. There are other individual promoters, sure, like Jagadamba Chandrasekhar holding 1.16% and Krishna Chivakula holding 0.21%. But when a single corporate promoter holds over 90% of the equity, that instantly tells an analyst that strategic control and all the real decision-making power rests firmly in one specific place. But you know, a capitalization table, or cap table, as it's usually called, is rarely completely homogeneous. Take a look at the other key players at the table here. We've got Anuradha Kuduri from the promoter group holding over 5.4 million shares. And then, quite interestingly, we have the Indian Institute of Technology Madras, IIT Madras, holding over 4.6 million shares. Having a premier academic institution sitting there as a pre-IPO shareholder definitely adds a really unique layer of diversity to this cap table. We also see individual selling shareholders like John Anthony Dexheimer holding about 1.4 million shares.
Okay, Chapter 4, How the IPO Changes Ownership. So we know exactly who owns the pie today. But remember, an IPO is a liquidity event. It's a mechanism for profound change. And honestly, this is probably the single most misunderstood concept for retail investors out there. So let's make it crystal clear how the mechanics of this upcoming public offering are going to alter that established pie. This specific IPO is composed of two completely distinct parts. First, you have a fresh issue aggregating up to 10,000 million rupees. This is entirely new money. The company is creating brand new shares, selling them to the public, and that 10,000 million rupees flows directly into Indo-MIM's bank accounts to fund operations, maybe pay down debt, or drive new growth. Second, there's an offer for sale, or OFS. In this part, up to 129.6 million existing shares are being sold. But here is the crucial difference. The money raised from the OFS does not go to the company. It goes directly into the pockets of the existing owners who are selling their shares. So just remember, the fresh issue builds the company, while the OFS cashes out the existing owners.
So, who exactly is cashing out their chips in this OFS? Well, the DRHP breaks it down for us right here. Green Meadows Investments Limited is offering up the vast majority, selling up to 120.5 million shares. Anuradha Kuduri is offering up to 5.4 million. IIT Madras is partially monetizing their holding by offering up to 2.3 million shares, and John Anthony Dexheimer is offering up to 1.4 million. Now, don't panic when you see this. It is perfectly normal for early investors and promoters to take some money off the table during an IPO. It's essentially the reward for taking on that early risk.
Of course, navigating an issue of this sheer magnitude, we're talking about balancing a massive 10,000 million rupee fresh issue alongside an OFS of nearly 130 million shares. Well, that requires some serious institutional muscle. The DRHP lists the book-running lead managers who are orchestrating this massive structural shift, and it includes absolute heavyweights like HDFC Bank, Access Capital, ICICI Securities, Kotak Mahindra Capital, and SBI Capital Markets. These guys are the architects, making sure that transition from a private cap table to a publicly traded one goes off without a hitch.
Now let's talk about the real effect of that fresh issue. When Indo-MIM issues all those new shares to raise that 10,000 million rupees, the total number of shares in existence obviously goes up. And this leads to a really fundamental financial concept known as equity dilution. Look at it this way. Imagine you own 10% of a 10-slice pie, so you have exactly one slice. If the company suddenly bakes 10 more slices to raise new capital, there are now 20 slices in total. You still have your one slice, but suddenly you only own 5% of the overall company. Even though the total pie got a lot bigger and richer because of that new cash, your specific percentage of ownership and your voting power has been diluted. Existing shareholders accept this dilution, though, because that huge influx of new capital is ultimately expected to make the overall company much more valuable.
And that brings us to our final section, Chapter 5, ESOPs and Investor Takeaways. You see, capital structure isn't always just what you see on the surface today. You also have to account for the promises a company has made for tomorrow. And that brings us directly to Employee Stock Option Plans, or ESOPs. According to the DRHP, Indo-MIM has an aggregate of 11,939,926 options granted to its employees right now under their ESOP plan. So why does that specific number actually matter to you? Well, because an option is simply a right to buy a share in the future. As those employees vest and eventually exercise their options, the company is going to have to issue brand new shares to them. That means that even long after the IPO is done, there's going to be further gradual equity dilution as those nearly 12 million options slowly convert into actual shares. Any professional analyst is going to factor that future dilution into their valuation models right now, today.
Let's distill all of this down and strip away a few common misconceptions. First off, a numerically larger share capital doesn't automatically mean you're looking at a stronger company. It literally just means the equity is divided up into more units. Second, just like we talked about, dilution isn't inherently a bad thing. It's a perfectly normal, necessary byproduct of raising the capital a company needs to grow. Third, you must always distinguish between the fresh issue, which injects actual lifeblood into the business, and the OFS, which is simply a liquidity event for the past investors. And finally, while understanding this capital structure is absolutely mandatory, remember that it's still just one piece of the overall puzzle.
There's a great saying among analysts: capital structure tells us exactly who is sitting at the table, but the financial statements tell us what the meal is actually worth. Knowing that Green Meadows owns 90% of Indo-MIM and knowing exactly how that fresh issue is going to dilute the pool, well, that gives you an exceptional understanding of the company's control and supply dynamics. But if you want to know if the IPO price is actually justified, you have to take all this structural knowledge we just covered and apply it directly to the company's actual revenue, their profits, and their cash flows. So we've successfully mapped out the ownership, the history, and the exact mechanics of how this equity is going to shift. But the single most pressing question is still hanging out there regarding that massive fresh influx of cash. We know 10,000 million rupees is about to flow directly into Indo-MIM's bank accounts. But how precisely is management planning to deploy that capital to generate returns for you, the potential new shareholder? Well, in our next explainer, we are going to tear right into the objects of the offer section of the DRHP to answer exactly where every dollar of that money is going. You definitely won't want to miss it. Until then, stay focused and keep learning.